We did it. We did it. We avoided a government shutdown. Thank the Lord. We can keep spending money. Oh, I was getting so worried that we weren't just going to be able to spend as much as we want. All right, let's spend away. So it's funny. I looked at, what the hell is this? What? Why does it look like that? Okay, well, futures are up, but I looked this morning, and like 20 minutes, the stock market the Dow was down 50 points. All of a sudden, I look and it's up over 100. I'm like, what's going on here? So okay, all right, guys, wins and losses Friday. So we'll get into that. And let's see. There you go. Mo needs a help wanted sign that says sarcasm in the back. Maybe I need a sarcasm czar. There's nothing like a good old czar in the United States. Let's get into some stories here. Okay, what should we do first? You know what? Let's do the truckers one first. So there's a big shortage of truckers in this country. We have some truckers here in the chat today. Don is one of my favorite in the bid and ask, and he is a trucker. He owns his own trucking company, and it's rough out there. And there's trucks that are just sitting there doing nothing. People don't want to work. They've put so many restrictions on the truckers as far as how many hours they can drive. It's becoming a really big challenge for companies to hire truckers to transport goods. I went to a Walmart yesterday to go and get Dave Portnoy's new frozen pizza, 7-8 on a frozen scale. You need to cook it 2 minutes longer than what it says on the box. But remember, that's on the frozen scale. So, but it was very good. So go to Walmart and get it. Anyways, the shelves were like unstocked. It was one of the most incredible things I've ever seen, but it makes sense. I mean, you have big ships like this sitting in the middle of the damn ocean, and you have trucks that are not transporting things. So, oh well. Supply chain distributions and increased need for more qualified truckers ranks among the underlying causes of the national inflation, 100%. The request for information will be from the Department of Transportation has submitted a questionnaire to 13 answer questionnaire to truckers. The thing is, I don't see any. I see 1 question mark, 2 question marks, 3 question marks. There's like, not all of these are questions, but there was a task force that was put together to actually ask the truckers. So instead of the government trying to figure it out, they're going to go to the boots on the ground and talk to them. So that is it's a novel idea. Anyways, Don, go answer the questions and send it to the president's desk, and you will be saved. Next, let's talk about this inflation. This is a funny story. My ridiculously simple inflation hedge. So this guy goes through a bunch of things talking about inflation. He spent a ton of money on non-perishable food items, not because He's especially hungry because it's a better investment than keeping money in the bank. Food prices are at 3% inflation. That's what they tell us. Bank rates, you can get a CD, a 0.75% return on a CD, and then it's taxed on top of that. I remember when 4%, when I was in high school, 2007, I was getting like a 7% return on a CD. That's a certificate of deposit at a bank. The one thing that has a great advantage over the inflation hedge is, what did he say? Oh, and food has one great advantage over that other inflation hedge, gold / Bitcoin. You can eat it. So that was a pretty funny one. I like that. What a great story that was. That guy is, you want to talk about sarcasm. That guy just sarcasmed his way onto Market Watch. That's the epitome of sarcasm. U.S. auto sales. Let's see. U.S. auto sales forecast to plummet in third quarter, and chip shortage plagues the industry. So we know that chip shortages they're beat up, man. I mean, these auto industries are beat up, and we're going to see some real numbers right now. Interestingly, though, Hyundai and Kia are still doing it. So they were positive. So a forecast from Cox Automotive, Edmunds, J.D. Power predict that vehicle sales from July through September were less than 3.4 million, down 13 and 14% from the same time last year when volumes were depressed due to the coronavirus. The severe decline, including an expected 24 to 26% fall in September, is due to the ongoing shortage of semiconductors in the new vehicles. I didn't realize this. I'm sure. Well, I don't pay attention to these things. I love cars. I don't really care about how they're made or whatever. But I learned something new here. I didn't realize that how many chips went into vehicles. Like, there's chips for your seats. There's so many chips inside of a car. I had no idea. I thought it was just one central chip. But that just goes to tell you I have no idea what I'm talking about. Don't worry. Shortage only affects Tesla. Just wait, Mitch. Just wait. Part of the shortage from automakers to sporadically shutter the plants for weeks, if not months. The lack of production combined with the strongest consumer demand has caused vehicle inventories to plummet to record lows. The entire U.S. auto industry, including Asian manufacturers, which were doing a little bit better than their domestic counterparts until recently, is in an incredibly volatile position right now, and we are seeing inflated numbers. Let me get to the bottom here where I really want to read it. Where were we? Hold on. Here we go. Where did I thought I highlighted something in here. Wait. I have to show this to you. I could have swore it was this story. Okay. Well, maybe it's not this story. Maybe it was. Oh, no, here it is. My bad. Edmunds expects GM and Ford to have the largest third quarter sales decline 31.5% and 29.3% respectively. An outlier for the quarter is anticipated to be Hyundai Kia, which Edmunds forecast will be up 10.1%. Cox Automotive also expects Tesla's third quarter sales to have risen about 26%. So can everybody just give it up for a disruptive company like Tesla, defying all odds, defying coronavirus, defying disruption? Yee. Next. Let's do the S&P. So the S&P, guys, this is absurd. This is literally absurd. If you think about this, the S&P went up this blows my mind. The S&P 500 went up didn't go up. The S&P 500 went 227 days without a 5% drop. That's not normal. I'm sorry. That's not normal. The S&P has dropped more than 5% from its all-time high for the first time since last September. The index went 227 days since a 5% drop, the seventh longest streak on record, with the S&P 500 gaining 29.4% during that period. That period where unemployment is terrible. Jobs are, you can't fill jobs. Record levels of debt. You go on and on the list, but the stock market's okay. All right, sounds good. Why are stocks falling? Because earnings estimates for companies and indexes have been falling. Earnings should have been should have been falling for a very, very long time, because these companies are manipulating their earnings using I personally think a lot of them are borrowing money to do stock buybacks and inflating their stock price. As supply chain constraints make it difficult for companies to access supply needed to meet demand, while the other high costs associated with the shortages are hurting profit margins. Plus, bond yields have soared, partly because of the Federal Reserve's indicated last week that it will soon begin reducing its bond purchases and the taper and whatnot. And this is an interesting one. The next stop could be the 200-day moving average. So, alrighty, let's see here. That was a very aggressive comment you got there, Gary. Very aggressive. All right, let's see. Let's see what the Fed will do. So this is an interesting story. Kind of runs through what the Fed would do. Guys, smash the like button for me. Also, at 9:35, so right after this stream, I'm going to do a private bid and ask only live stream. I'm going to jump on there and do some Q&A, do some teaching. I'll probably be there for about 30 to 45 minutes and come with whatever you want. I posted the link in the Bid and Ask Nation in the general chat, so go in there, click it when we're done, and move on to see more of me. Who wouldn't want that? Let's be clear. The risk of default is very low. He's going back to what Janet Yellen, she's now the Treasury Secretary. Back then, she was chairman of the Fed. And we were looking towards default in 2011. Here's the playbook. First, the Fed makes a payment plan. If it's instructed by the Treasury, the Fed will roll forward and schedule payments of principal and interest only in one-day increments. So basically, it'll just be delaying the default until everything gets squared away. Each evening, the Treasury will make a decision whether to release or delay the payments based on cash balances projected for the next day. Okay, next, policymakers mapped out plans for bank supervision and regulations. If there's anybody that's probably really good at planning what's going to happen, it's probably policymakers. That was sarcasm. The Fed will treat defaulted Treasury obligations the same as non-defaulted obligations because that makes total sense. Moreover, those securities will not be adversely classified or criticized by examiners. Also makes sense. In each case, supervisors would work with the bank to determine whether it was, quote unquote, still in a fundamentally sound condition. I wish I could swear. You're in a default situation of the frickin' United States of America. There's no fundamentally sound condition, despite the temporary drops in capital regulation. There's three scenarios that this can play out in. The first allows the Fed to transact with defaulted Treasury obligations. Guys, you're not gonna hear this on CNBC or anything like that. It might be boring, but I think just pay attention to this. The first allows the Fed to transact with defaulted Treasury obligations at market prices, so long as it seems certain that delayed interest and principal payments will be made in full and in relatively short order. The second group eases constraints on the money markets, of course. And the third, after exhausting all other priorities, the Fed would move toward default securities the defaulted securities onto its balance sheet using targeted purchases or swaps. So basically, they're just going to throw it over there and everything will be okay, and then we can just build up more money and then default harder in the future. Default harder than me. The Federal Reserve, the repo. So I'm going to talk about repo real quick, and then I'll get on to your questions, and we'll move on from there. All right. 1.6 trillion. So those of you that don't know what the repo rate is, the repo rate is banks need to stay liquid overnight. Liquid meaning they need to have cash on hand in case of an emergency situation. This became a big deal back in 2008 when Lehman Brothers and et cetera and all the banks defaulted and they're bye-bye. I mean, you have AIG go away, you had Lehman Brothers go away, et cetera. So here we're going to have the banks. I'm going to draw this as best as I can with this little pen. Banks. And this over here is supposed to be hedge funds. I'm going to type in HF, institutions, people with big money. And then, of course, you have right now, in a bad situation, Fed. So the Fed should not be in this category, but they are. So this is repo. And when you hear reverse repo rate, this is what you're going to see. So overnight, the banks need to have liquidity to stay viable and be able to pay loans and debts and et cetera, everything that they're doing. So in order for them to have liquidity overnight, if they give all their money away, they need to replenish that liquidity. So what they're going to do is they're going to give a note of, say, I'm going to call it 1%. Let's say it's a 1% note. They're going to give that over to the hedge funds, institutions, not the Fed right now. And the Fed or the hedge funds and institutions will give them back money. They're going to give them back cash. And what they're going to do is they're going to be liquid overnight. They're going to get promised to get a return of 1% in the morning. The morning comes around, I'm going to use pink. The money goes back to these guys with plus 1% interest on whatever that loan was. And everybody's happy. And that's the way it has worked for a very, very, very long time. And it worked well. The problem is interest rates got so low. So now these hedge funds and institutions, they say, well, if we can go in there and we're not going to give our money to the banks overnight for basically $0 back in the morning. So in order for these guys to stay liquid, who comes to the rescue? Daddy Fed. The Fed, they start sending cash over to the banks overnight. The banks are effectively paying $0 back to the Fed. So all of this is happening overnight. This repo rate, it's a couple billion dollars, couple $100 billion, something like that, if the hedge funds and institutions are doing it. We are now so illiquid with these banks. It's $1.6 trillion that's changing overnight between the Fed and the banks. And the Fed is not collecting interest on it. And if they are, it's marginal. The hedge funds are not participating at all. And the banks are doing whatever they can to stay liquid. So that's what the repo rate is. And if you look, here it is. It's a record of $1.6 trillion to keep up with demand on the overnight repo rate. If you want a really, really, really good explanation on that, go to YouTube and type in WSJ, Wall Street Journal, repo rate, and there's going to be a video that comes up, and it is an excellent, actually, you know what, I'll just pull it up for you now and show you guys what it is. Let's see here, YouTube. So if you type in WSJ repo market, it is this video. It looks like it has an oil can, and it explains perfectly exactly what the repo rate is. And you guys are gonna, it's very beneficial to you. So, all right, that's that. Let's see. Should we check the yields? We might as well check the yields. And, oh, look at those yields. All right, the 10 year's ticking back down. Let's see. There's no earnings today. We don't need to worry about that. Let's just check into next week real quick. Nothing on Monday. We're good there. So everythingmoney.com. Let's do this real quick. I hope you guys understood that repo thing. So if you want to join us at everythingmoney.com, Discord access, 6,200 people, 6,300 people, $7 a month. This is going to be moved to $28, so get it soon. You're going to get a discount right now. It's moving up today, October 1st. $28. This gets you software access, gets you all of the exclusive content that we're putting out. A few good minutes. We're putting out a couple videos a day on that just for subscribers. We're trying to give you guys as much exclusive content as we can, and I hope you guys enjoy it. And just keep telling us what you want. If you want to join the Bid and Ask Nation, this is going to $78 a month. This gets you into my tier in the Bid and Ask Nation, exclusive trading tiers, employed trader series, training videos, and just a great community of 800, 900 people that just love trading and are doing a great job doing it, whether you're interested in day trading, swing trading, and we'll do some charting stuff in a few minutes. If you want to join Paul's Super Shorts monthly basis, it's just the more exclusive tier. You get access to both me and Paul, and we chat with you. Basically, we just text in that thing all day. Well, when markets get better, we do. $500 per month will get you that, and it's just a lot of learning experience in there. If you want to do a one-on-one trading session with me, I actually just scheduled one yesterday with David. And David, if you're out there, respond to my email. $750, 1-hour session on Zoom gets you that, and it's really great. A lot of people, the people that have done it, have been really doing a great job. And if you want to do a real estate deal with Paul, $10,000 for 4 hours of his time. And if you're doing a deal in this kind of market, yes, probably behooves you. Let's do wins and losses. I'm going to drag my Discord over here. All right. So basically every morning I go out, every Friday morning I go out and I say, guys, send me your wins and losses. And if it's a loss, tell me why you lost. I really want to know why you lost. So we did get some of that. So first one, Apple. We lost. That's employed trader series. We lost on that one. Hey, it is what it is. Doge to the moon. That's nice. Let's see here. We're going to lose. You should expect to lose on 2 to 3 out of every 5 trades, but the ones that you capitalize on, you should do very well. Alex, 6% swing trade on open. This was a positive 6. I clarified that with him. Let's see here. Oxy, 6% gain, 2-day swing trade, currently down 5% on Penn. I followed the rules and entered late on Monday. Then I just got caught on the Tuesday, Wednesday sell-off. I'm just going to hold it as long as it's not a big position. I only entered with 25% position. Excellent. Excellent. So let's see what else we have here. What else do we have here? WHC long, plus 2.75% and holding. Don, this is my man. 1.6%, plus 3% NET short, plus 6.1% on a day trade, 5% on Apple. That was our Apple one. Where was my big one? There was a big one in here. Hold on. Look at this one. There we go. D, day trades. Dollar Tree, 1.9%, 1.7%. AEHR, 7.1%. This is day trading. Swing trading, UVXY, 11.5%. And then here's all of her day trades from last week. His day trades from last week. It's incredible. So if you want to join this Bid and Ask Nation, it's a great place to be. Lot lizards. Yeah, we were talking about lot lizards, baby. Lot lizards are going up during inflation. The Bid and Ask Nation stays the same if you join now. Amen to that. All right, guys. Let's do some Q&A. Remember, smash the like button. Also remember, follow me on Instagram. Also remember, 9:35, so 15 minutes from now, I'm going to be doing a private live stream for the Bid and Ask only. The link is in the description of the chat. Not here, the description of the Bid and Ask Nation chat. And here you go, at TraderMo_EM, at Paul Gabriel, at Seth Kirchanan. Follow us. D is a girl. D is a lady. D is very, very good at what she does. I am very, very pleased to have D in there. All right, let's do it. Give me some stocks. LVS, let's do LVS. Not everybody puts up their, first of all, not everybody puts up their picture in the Bid and Ask Nation. Second of all, are you even allowed to call a lady in 2021? Get woke. All right. I'm just trying to be as woke as I can. All right, Las Vegas Sands. So the thing that I love about Las Vegas Sands, I love that gap right there. That gap is eventually going to fill. Just let it consolidate here, and all it's doing is trickling down. Just let it consolidate right here. Even here, I would not short this thing. I would just wait, let it consolidate, and bump up on you. That is exactly what I would do with that one. All right, let's see here. Next. NLS. What is that one? I haven't seen that one in a long time. Nautilus. So Nautilus was a great value play for me. Well, I didn't execute the trade, but it was a good looking value play. Plus, I really love their gym equipment. This is a dog stock. It's just coasting down on the bottom, under all 4 major moving averages. You notice that it's really not doing anything. Let this listen, don't even trade this stock. If you want to throw a tracker share on, it's $9 and let it move into the sweet spot eventually. You do have a gap to fill, but anytime soon, this is not an interesting trade at all for me. Next. CRSP. Let's see what we got here. CRSP. Look at it, guys. If you just look at everything in today's market, you just see this downtrend. I'm going to pull up the fangs. This one, I mean, you're holding a support line. I probably wouldn't do anything with it. I'm going to pull up Facebook. Both downtrends. I'm looking at stochastics here. Apple. Both downtrends. Microsoft. Let's see. This one is technically up, but I told somebody to take profits on this yesterday. Let's see. Netflix. Okay, this one's not the worst. It made all-time high yesterday. What's the other one? FANG, Amazon. Let's see what Amazon is. Yeah, both downtrend. So I'm looking at these stochastics. They're both down. So it's very telling of what this market is. Let's look at XLF real quick. I just want to look what the banks are doing. Both downtrend. So you're down over here and you're down over here. So just if you guys want to know what the market's going to do, follow the banks. Follow the banks. Is Disney doing a full breakdown? Disney is holding a very, very strong support level at this point. Right here. So you can actually see that it dipped down there a couple months ago. It gapped up there. It dipped down there. And it's just holding that same area. So right now, and actually a little bit right there, Disney's probably going to hold this level. It very well could fill the gap down to 155. Man, I really hope this goes to like $100. That would be great. I just can't wait for this market to fall apart, and I know so many of you feel the same way. Murphy, I'll be honest, I'm hesitant to do anything in the market right now. Amen to that. Space is looking good. Let's see what Space is doing. I assume you mean from a daily perspective. As soon as if you can get this red line to cross over yellow, then yeah, you'll be all right. And I think that's going to happen if you bump over the 50-day moving average. Disney is a downtrend. Disney is absolutely a downtrend. How about Target, TGT? Target is almost... Target's holding it's a support level, but it's a weak support level. I mean, you're only working with a couple of days in here. It's really not that strong, but you have a downtrend. So I can see Target falling down to just above $210 a share. You're getting quite a bit of selling volume coming in. You're going to, okay. So the good news is you have your 100-day moving average at $216. So that won't be bad. Mo, I just want cheap stocks. Yeah, same, man. It's been a long time. All right, let's look at Nike. So Nike, I shorted Nike. I made 12% on this, something like that. Yeah, this was an awesome short for Nike. Really good selling volume. I sold it right here, right as it dipped below the 200-day moving average because I thought that Nike was going to hold the 200-day plus the 200-day. Well, let me see if I could draw this line perfect. The 200-day was almost exactly where the gap filled. So, yeah, it was great. Now, if it dips below if it dips way down here in this area, then I might go ahead and short it again and try to run it down just below $136. But that was a really good short, and I was very happy with that one. Next, FL short. All right, so I'm happy you asked me this question. Let me zoom in here. So yesterday, obviously, with them, they had a big drop. Now the thing is, with that drop, I like that they closed the day down here. I like that we didn't have something that looked like this, where the stock price came down and went back up, because if I would have had wicks like here and here, that would have been there's no consensus on the price. But we did finish the day with an engulfing candlestick down, which was great. Now, you got to have another one. Let's see what's going to happen today. It's opening the day at the same spot it closed yesterday. If we can just get something like this today, I think you can go in. More importantly, I would go over here and try to swing it, because I would not do a long-term trade on this. Try to swing this thing, and it'll help you out. It'll do very well for you. Let me see what this. Okay. All right. Let's see what else we got. MRK. Merck is the company that spun off from Snowball. Hello, Seth. Seth is in the house. All right. Perfect example of what I was talking about with that pullback. So you notice yesterday, Merck ran up here. It got to this price, and then you have this long wick. It pulled all the way back down right below its 50 and 200-day moving average. That's exactly what happened. This is why moving averages are so powerful. This is why I like to have engulfing candlesticks, because this just shows me, let's see here. Even the day before yesterday, Wednesday, it ran up, it touched the 150, and it pulled right back down. Yesterday, it gained a little bit, came right back down and closed below both of them. So it's having a very difficult time getting through the 150-day moving average, and you're going to need a lot more volume than that. Those little two blips just clearing the average daily volume to get through there. So just keep paying attention there. But that is a great example of why you need to wait. Okay, big. Big is the same thing as FL. Let it calm down. I would probably wait until Monday. And if you get it on Monday, if you get an engulfing candlestick on Monday, you can go ahead and do something with this. But right now, let it settle down. It's Friday. Who knows what's going to happen? I'm zooming out here because I want to see the support level. and you can see it. If we just draw, I'm going to draw straight across here. It literally stopped right on that dime of support. Look at that. Here. Look at that. That's incredible, huh? It just stayed right there at that support level. So be careful, because it could hold that very well, and then it could start moving back up on you. This stochastic can easily just turn back up. So that is another great example, another great teaching example. All right, BBBY, same situation. I'm sure it's gonna look exactly the same. It closed the day, and if you just draw that line there, you have 1, 2, 3, and the gap, and it dropped right to there. So you can see how powerful these are. This one had a little bit more price fluctuation yesterday. The other ones didn't have that many wicks. This one has 2 wicks, top and bottom. So if I'm you, I'm doing everything over on this chart. If you get an engulfing candlestick Monday, go ahead and do something. But for right now, let it calm down. Let Friday be what it is. Take profits if you need to, and move on from there. Okay. You can do 2 things. I don't know what that means. Yeah, I know, Joel. I know how to draw lines, but I'd rather use my marker. It's just easier than me switching back and forth on a live show. All right. Microsoft. So Microsoft is technically still an uptrend, but I advise taking profits on this. I advised taking profits on this up in this area when we started to get that stochastic rolling over. And we're getting to the point of a downtrend. If this red line crosses into the 80% area, we will be a downtrend. I have to think that that's going to happen below the 100-day moving average. The market is now open, so we're going to see what happens today. But that is exactly what I'm thinking. Okay, I'll do one more, and then I'm getting out of here because I have the private stream. If you are in the Bid and Ask Nation, go into the chat. It's in there. It's posted in there. Hey, if somebody's in there, can you just copy and paste it and post it again so it's new and refreshed? And I will be on there in a couple of minutes, and we'll just do all your guys' Q&A. Let's do one more. XOM, good call. Let's do some oils. We didn't even do any oils today. All right, guys. It's getting there. So let me look at a line chart because remember, we need to create a W, and perfect. Frickin' perfect. So we had that big pull, the flagpole pattern. I said it was going to pull back. I thought it was going to pull back down to here, but let me draw a line here and see I missed this. I missed that, and I missed that. So I thought it was going to pull back here. It pulled back down, and now it's starting to move again. So this is an amazing W formation. Guys, put this on your long-term watch list. I think this is going to be something really good. Now, it's premature. We need to get this red line moving into the sweet spot, but it is looking pretty good. So, all right, guys, that's it for today. If you're in the Bid and Ask, I'll see you in a few. If you're not in the Bid and Ask, I'll see you on Monday. We will do it all over again. Everybody have a fantastic weekend, and I will see you on Monday. Thank you.